Okay, good morning, everyone.
Good morning.
We'll call to order the Investment Committee for July 8th, 2013. And before we do roll call, I just wanted to make a couple of new introductions because, as you can probably see, there's some changes going on our board. So first, I want to introduce our new board member, Tom Unterman. He is our new governor appointee. So just met him on the cab over here. And so welcome, Tom. We're glad to have you. So yay.
And then, Tom's a public representative of our board.
Okay.
He's filling that position.
Great, thanks, Chuck. And then I also want to introduce Michael Cohen, who has been the acting deputy finance director and now has officially become the director of finance starting in September. Is that right? Yeah. So you have heard that Ana Monta Santos is moving on to other things. So Michael will be our new director of finance. So welcome to the board as well. I know that's a huge honor, so we're really looking forward to working with you and having you join us on the board. Roland, can we do roll call?
Good morning, committee members. At this time, I'd like to take roll. Mr. Moore? Here. Mr. Cohen? Here. Mr. Lawson? Here. Ms. Dillon? Here. Mr. Rosensteel? Here. Mr. Ziegler? Here. Mr. Unterman? Here. And Mr. Chung? Good morning. Vice Chairperson Hendricks, you have a quorum?
Great, thanks, Roland. Before we jump into our agenda, we are going to have just a moment. I think Chris Ailman is going to, as many of you know, our board has experienced personal issues and challenges. And at the end of the day, when I come to these board meetings, I'm always reminded that family and our relationships with people are the most important thing. I know as teachers, we believe that. Our students and the people that we love are the most important thing. So we're going to take a moment, and Chris is going to tell us a little bit about what's been happening with our investment family. And so I'll hand it off to you, Chris.
Thank you. David Castillo was a very awesome investment officer, appeared before this board many times. He was involved in a very, very serious bicycling accident on June 29th, sustained very heavy injuries, and I am sad to say succumbed to those injuries on July 5th and passed away. David was only 45 years old. He is survived by his wife Amy and his two children who are 8 and 11, and our hearts go out to them. David was started with us in 2004 in November. He was an investment officer 1. Before that, you should know David was the only person on our staff that had his JD. He was a lawyer. Started his career in law, went to Cal Poly San Luis Obispo, and then to UC Berkeley. Bolt for his law degree. He worked for Orrick Carrington Sutcliffe for a number of years, and it was just shared with me. He was on a plane and sat next to Real de Roche, our director of private equity for many years, and shared that he didn't like being a lawyer and really loved investments. And Real said, well, we have openings, but you take a big pay cut. And to show his commitment is amazing. But David left a $200,000 a year job in San Francisco and accepted a job at about $38,000 a year with us here. And he started as an IL1 in credit enhancement. As Margot said, he just tore into that job, did an awesome job. He moved over to private equity and very quickly was climbing the ladder. In 2006, he became an investment officer 3 and joined Global Equity. And the Global Equity unit was where his true love was. David was a portfolio manager for us. He was our co-acting director of Global Equity. Looking through some of his applications, David had written to us that when he was applying that he loved investing, he loved investment, and that he put in one note that he did not want to invest alone in a dark trading room. He wanted to be part of a team. And David Murphy, who's here, and the global equity staff who's upstairs right now will tell you he was very much a teammate and part of a team. He loved all the facets of the markets. David would constantly communicate his views on the markets and share that with us. But he had a passion for cycling. He had a passion for his family, and I need to get the remote control. It's around here somewhere.
There it is, on the left. Good.
That's it. Could you guys hit the slide? Thank you. I had a picture of David and his daughter and his brother. And also a picture. David loved to compete. He competed in every single event we had in the investment office. One of the silly ones we do is loud or ugly Hawaiian shirt contest in the summer, and he was always active at hitting up stores and finding the loudest and brightest one he could. We've talked about today's meeting. It's hard. You're not catching us at our best. But we know that David had a passion for investing and especially for asset allocation and would want to be here and would want us to do this. I have our condolences, as I said, go out to his wife Amy and his two children. We're going to, as a family, step around and support them in whatever way they need. I really want to credit David Murphy and CalSTRS. Their disability staff went to bat and even took the forms out to Amy in Folsom to get him retired in a disability while he was still severely injured, and just really looking out for them. So if I could ask if we could all just have a moment of silence in remembrance of David. Thank you very much. And thank you for the chance, Sharon, to remember David. Many of the teachers in the back of the room will remember David was the one who led the panel on active-passive at the June meeting. We're going to keep that up on the website for a long time, and also make a DVD for his family of some of the stuff he did, because we know his kids are going to want to see what was his passion. So we're all hurting, but we will keep David in our hearts and minds.
Thanks, Chris. Thank you, Chris. I told Chris too that, you know, we want to dedicate our meeting today to David's honor, because we did struggle with how to move forward with today's meeting, recognizing that most of the investment staff are going to be challenged to kind of operate today. But I think we agreed that we'll bring honor to David's memory today by the work that we'll do. So thanks, Chris. All right, we're going to just take a 5-minute break, and then we will jump back into the agenda. So we'll just come back in at 10 till 11. Okay, item number 1 is the approval of the committee agenda and work plan. I entertain a motion to approve.
So move.
Great, approved. Item number 2 is this, what? Oh, I'm sorry, we need to vote on that? Okay. Okay, all in favor of approving the committee agenda, say aye.
Aye.
Opposed? Great, all right. Item number 2 is the CIO's report. Chris, take it away.
Thank you. So the defined benefit assets, this is an estimate at June 30. So if Bloomberg is watching on TV, please do not write an email about this, or P&I. This is all very preliminary information, just to give, especially the teachers in the back of the room, a rough heads up. Deborah Smith, our Director of Operations, just handed me this number updates regularly because, as we've talked about, 30% of the portfolio is in very long-term assets that do not price daily. But the initial estimate for a June 30 value is now up to $165.8 billion. So pretty close to where we closed at May 31. We're seeing some nice increases in the real estate portfolio and a fairly large increase in the private equity portfolio, almost $1 billion. I should have unaudited but reconciled performance numbers for you, maybe by Friday, but certainly by next Monday. So I will get those out to you. I would say that right now we're somewhere, and I have a slide, we're somewhere up in the 12% range, and I'll know better how high or if we crack a higher number on that. Here's the asset allocation as we were unreconciled and without the private assets closed. The slices of real estate and private equity would actually be a little bit larger slices of the pie. But it's been pretty static in April, May, and June, just with the global equity portfolio growing a bit. And you can see on the fiscal year that we had a very nice climb during the year, the rapid rise from December on. June was a down year for the equity month for the equity markets, but as we're seeing, the portfolio is going to do better. When you look back at the financial markets year to date, for us fiscal year to date, very strong year. U.S. equities up 21%. Now that's not with our adjusted benchmark. That's just the Russell 3000 straight. Europe, which surprised everybody, up 26% across the board. And then Japan was obviously with Abenomics was the real surprise. All of that occurring almost from about Thanksgiving on. It's important to look at it after currency because the yen depreciated, but it was still up about 21%. The graph on the other side is the yield curve. And if you went back and looked at our quarterly reports during the year, you would see that the yield curve was pretty much right on top of where it was for June 30 almost all year, except in about the last 25 trading days. Ever since May 22, when Ben Bernanke uttered the T word, as I have told you, taper, suddenly bond yields in the long end especially rose dramatically. Now you can see in the short end they're still pretty anchored, but to everybody's surprise, from about 5 years on out, the entire yield curve shifted up pretty dramatically, and so bonds are right now showing a slightly negative yield. The Barclays aggregate is posting a negative about 0.7% return on the fiscal year. Long government bonds, which had been the stellar investment in the prior 2 fiscal years, posted a negative 8%, almost all of that in the, since May 22. So here are, again, rough estimates, not actuals. These are rough estimates. They will change of our results. And the good news is that a majority of our asset classes did outperform their benchmark. You can see that global U.S. equity just a smidge above. Global equity did very well, looks to outperform its benchmark. Hats off to the fixed income staff. It looks like they produced a positive return where their benchmark would have had a negative return, so they added a lot of alpha on the year. The private equity and the real estate numbers are massively subject to change, so don't draw a conclusion. We do think, and we have said repeatedly, that private equity will underperform its benchmark simply because its benchmark is public stocks. And you can see over there on the left-hand side, public stocks were up almost 20% over that time period. So private equity will have a hard time. That's really a reflection of this slow growth economy, that longer term investments are really taking time to see their maturity and their fruition, where short-term investments like public stocks are rising very rapidly. The good news is, and I want to credit Mike DeRay and his staff, I think the real estate portfolio will outperform its benchmark. Now, we have 2 benchmarks. We have NCREIF and Odyssey. Odyssey hadn't posted yet, but we think there's a good chance that for the first year in quite a few, that real estate will turn the corner and outperform its benchmark. And I don't have any data yet on inflation sensitive, but we'll get all of that to you shortly. So You bet.
Board members, if you have questions, I think, Chris, you're okay with us just asking them as we go, correct?
Of course.
Okay. So getting back to the U.S. equity and non-U.S. equity data in your I don't know if it was your write-up or INV 12, you talk about there's a bullet point where you say broad U.S. equity valuations are quickly approaching unfavorable levels, while non-U.S. valuation levels are relatively more favorable. And I just wonder if you could comment on that a little bit more, flesh out that for.
No, thanks, and especially for the new board members. This is a standard CIO report that we've evolved over the years. It's totally customizable, so if there's other things you'd like to see in here or see in a different way, just tell me and we will change it on the spot. But INV 11 is intended to be a snapshot of economic statistics to give you a rough idea of where is GDP and the economy heading. 12 and 13 are actually snippets directly from Pension Consulting Alliance. In the last couple of years, PCA, our general consultant, has begun to produce risk reports, and I include part of them in open session and part of them in closed session. So these are their takeaways based on comments they're seeing in the market. And I would tell you their views on the equity have to do with the fact that the PE ratio is at median or a little bit above, and certainly with the movement in the markets, as we've said, the markets look a bit tired. Emerging markets are starting to look attractive, but that's from a statistical standpoint. You also have to back up and try and decide from a fundamental standpoint, if developed markets are slowing, like the US, Europe are struggling, how much is that going to impact the emerging markets? And then the big question always is China, a China slowdown as to how great or large. So those are very long-term takeaways. And Neil, if you want to make any comments, holler. I put the circles on INV 13 just to draw to your attention. The upper graph is intended to show you unfavorable and favorable pricing, as it says. The bottom graph, PCA always tries to point out that those are just extremes. Doesn't mean you want to sell that area. It is something to pay attention to. And we have talked about interest rate risk probably for better part of a year or two, and said that this will stay up in the extreme range. Interest rates are at 200-year lows in the U.S. and 300-year lows in the U.K. So we recognize we are absolutely historic levels, but that may still be true for about another year, year and a half. So, but we're keeping our eyes on it. That help?
Yep.
I know it's certainly on your mind is where is the 3-year return, because that affects funding. The good news is the 3-year return is looking like it also might be about a 12% print. That's subject to change as well. So this is the trailing 4 years are the bars, so you can see each individual fiscal year. Since it's a rolling average, we care about the fact that starting here on July 1st, we lost 2009-10, so that nice positive year drops off, and we have the next 3 years. We obviously need to earn something north of probably 8% to keep the 3-year average at above 7.5. So we're going to have at least a bit of a tailwind behind us for now, thanks to 2010-11, but we still have to keep our pace up. And that's the 7.5% actuarial assumed return goal. So this is another chart that is totally up to the board on how you want it done. This is a request was to, in essence, for me to climb up the crow's nest and look out on the horizon and tell you what I thought I saw as risks that may or may not become a factor. And it was requested of the board a couple of years ago that we be real big picture. So you'll see some things on here, such as climate change, earthquakes, near-Earth objects that may seem a bit obvious and silly, but we wanted to be able to focus on all the risks that we look at. And the other one I would highlight, obviously many of these are very well known to all of us and it pop up in the news on a regular basis. About halfway down, you'll see internet disruptions, hacking. We subscribe to, or have subscribed to Oxford Analytica, which is a service started for Henry Kissinger And they have listed internet disruption as their #1 global risk for almost 3 years now. They think it has the biggest potential impact and the highest probability. So while we have had little snippets about hacking from different countries, that remains a very significant risk to the global GDP. And then the other thing would be that Ben Bernanke's term does end at the end of this year, so you're going to start to hear a lot of speculation about who his replacement will be. On the positive side of the ledger, as I've said before, you don't fight the Fed, and they are continuing to ease. The question will be, when does the taper begin? And you'll hear more from us really talking about the difference between a beautiful deleveraging and an ugly deleveraging. This phrase comes from Bridgewater, who is the largest global macro hedge fund, and we do invest with them. A beautiful deleveraging is pretty rare, but they think it is possible. Typically, you see an ugly deleveraging when it's a country, and this obviously applies not to the U.S., but to UK, to Germany, and the Euro bloc, as well as to Japan. So this is a global impact to everybody. In an ugly deleveraging, you typically have stagflation. So those of you that were doing business in the 70s might remember win buttons, whip inflation now. Because we had inflation and no growth in the economy. It's as bad as it gets, other than a depression. So that would be the ugly deleveraging, which would be bad for everyone. But we will keep monitoring the chances for a beautiful deleveraging in the U.S., which we would put as high as 2/3. So, but we'll have a lot of time before we get into those approaches. Last month, you had a couple of different information requests, so I just want to share and suggest that we start closing the loop on those information requests, because I tell you we did them, but we don't tell the audience we did them. So you had asked PCA to include some of the funding scenarios in their asset allocation study, which they have done. Also, we had public comment on the Hyatt Hotel in Phoenix, and while it was late, I did on late Friday finally got out to you the information on that. We can always do follow-ups. And then we also brought up to you that CTA had mentioned to us a letter from the Nurses Association in Massachusetts, and we're pleased to see they reached an agreement. So those are completed and done. Are there any questions about my part of the report? Then what I'd like to do is pretty rare, but we wanted to call up Nancy Sims from the Twigo Foundation. Nancy is in Oakland and was kind enough to drive over. Twigo is an organization that we have been involved with, and Nancy can correct me, but just about since its inception. Come on up, Nancy. They'd asked boards to pass resolutions committing their support for Twigo, and I said, kind of don't do resolutions here very often, but I invited her to come up and talk about it, because I realized we literally have been involved in Twigo since the mid-90s, and many of you don't know about it and haven't had a chance to hear. So I wanted to invite Nancy just to talk briefly about it. And it's hard to see, but those are all the business schools they are involved with. I noticed USC sticks out a bunch. That's kind of obnoxious. I see a Stanford tree, so we'll root for that. Nancy, go ahead, please.
There we go. Well, good morning. Thank you so much for this opportunity. And certainly for those who are familiar with Twigo, to provide you with an update, and as well for those less familiar, to give you sort of as Chris mentioned, a brief overview on the organization and how we have evolved over what is soon to be 25 years of service to the financial services industry. In terms of my own bio, I have been in a role in various capacities within finance for almost 30 years and have led Twigo for 15, with a primary focus of I think really preserving the originating mission of the organization, and as well to make sure that as we evolve over time with our programming, that we are in fact remaining relevant in terms of not only what's expected for talent, but also helping them to develop in their careers as they're thinking about new areas that are emerging and those requirements. The Twigo Foundation was really founded on a belief that opportunity exists for talent, regardless of certainly race or ethnicity, with the right academic success and the skills and talent in investments to be able to participate in the movement of capital in this country. And what we wanted to do initially, when Bob and Sue Twigo set out to found this organization, was to be a vehicle for bringing that talent to firms and to pension funds, which has evolved significantly in the last 5 years, with new talent that's ready to serve and bring that expertise to your organizations. Further, I think we have operated with the understanding that there was a vision that Bob and Sue had, which is actually contained in the overview materials that you have, but I'll read it very briefly. And it was that one day many of the talented individuals who have served will be seated at the boardroom table, will be acting as significant financial decision makers, positively impacting communities, or leading as CEOs of their own business enterprise and furthering the hiring and development of future generations. And I think from the standpoint of it being a metrics, we certainly have seen over this period of time tremendous success among Twigo alumni. Today, there are 14 who are serving as investment officers of either public pension plans, endowments, or foundations. We also are seeing a growing presence of Twigo alumni as investment consultants, as well as the more traditional areas of finance like investment management and investment banking. And then, of course, a growing population in the alternative sector as well. So again, I think that the traditions of knowing Twigo has been that we were a fellowship program. Individuals apply to our program as they are considering alongside their application to business school. And once they are accepted to business school, they are then eligible to apply for our fellowship. We award between 50 and 65 students a year the opportunity to become a Twigo Fellow. They are provided a scholarship, they are given ongoing career development support, and job placement assistance. And that is a lifetime proposition and a relationship that we maintain. So for us, one of the unique elements of this organization has been that we stay connected to those that we bring into this program with a very strong expectation that they give back. And to date, more than 75 of our alumni have organized to create a separate 501c3 with the sole purpose of being an endowment that would in fact support and take over the cost of scholarships in the future. To date, they have raised $700,000. So we see that they are taking that on their own, given the relationship and all of the work that has been put into their own careers, and really trying to build a legacy for the future. But additionally, we took a strategic step in 2010 to create a separate vertical known as the Twigo Institute. And that was really from our own research that by graduating from business school and moving into the industry, there still are a set of very unique but important career development needs that the talent on the postgraduate side requires. And rather than presume that we had done our job by simply seeing them move into industry, we decided to formalize our support to now what is nearly 1,000 individuals who hold the distinction of Twigo Fellow. So we are there for them as they are making the next step in their career regarding entrepreneurship, whether they are moving into new areas and making job transition. The Twigo Foundation has benefited from being close to this population to sort of see where the trend line is moving and how we can either create formalized programs or to continue that one-on-one sort of high-touch approach. To do that, we have been very specific about making sure that the programs we create are both innovative and at the same time would complement other initiatives that are in place. So some of those programs are actually in the overview book that you've received, which address women in leadership. So our Groundbreakers Summit that we host every year. We also have an initiative that supports some of our alumni who've become emerging managers. Further, we are working with those who are interested in board governance. So trying to create a pipeline of future talent, maybe not ready today, but certainly poised for the future. And those opportunities, again, I'm happy at any point in time to talk with any of you about the details of those programs. But our relationship with pension funds, as Chris mentioned, has been since inception. And we have benefited, I think, from the richness of knowledge and perspective that has allowed this nonprofit to be able to, I think, move our programming in a direction that keeps our talent informed about what's going on with capital allocators and how they should think about their career path, how they should think about their businesses, And as well for the nonprofits specifically, I think one of the most valuable things is having pension plans representative on our board. And that starts with, CalPERS and CalSTRS, names like Sandra Parker and Eileen Okada and others who have been engaged since day one, to those who today, Chris and Solange Brooks, who are members of our advisory board. It's invaluable to us to have, I think, their perspective, particularly since Sarbanes-Oxley impacts nonprofits in a very significant way, and knowing that there is an attentive eye and ear to issues around conflict of interest, to accountability and transparency, and as well the integrity of the work that we do every day, given the responsibilities that we have not only to our constituents, being the students and the alumni, but also to the many firms that are supporting us financially. I think bringing that level of dialogue is critically important. We also, over the years, I've shared with Chris, and I think he mentioned it, have received formal resolutions from up to, I think there's 18 pension funds across the country who, during the course of their own work regarding diversity, have expressed first the fund's commitment, but then also an acknowledgement of the work that the Twigo Foundation has been doing. The value of that is merely just the statement to the broader community of the importance, but also an opportunity for us to engage in dialogue with organizations year over year as they're thinking about how to embark on creating diversity and a more inclusive environment within their companies. Further, many of the pension plans also host summer internships for students, which has been, again, invaluable to be able to have this experience. I'm sure that it's not of any surprise that too often MBA students in general do not understand the pension side of the equation. And it's a wonderful opportunity to bring them into an organization like CalSTRS and give them that experience over an 8, 10, or 12-week period to take back and round out their education. Also, I think that Chris on 2 occasions has actually hosted some of our fellows and alums here, which is wonderful, and we'd love to continue to do that. Again, to broaden their perspective to meet other investment professionals from the fund, and a great way even for them to do some entry-level informational interviews to find out if this really is the right career track. As you also saw in the overview, our promotion of careers in this sector, in this space, has been critically important to us. And I think because the founders impress upon each of the members who join the importance of giving back to their community, what better way than to really take it to the side of public service? And while there has always been that discussion about a trade-off relative to compensation, what we find is that we are offering them the same level of rich experience, the high caliber of investment expertise. And for many of them, that decision around compensation has not been as daunting as one might imagine. It comes at a time in life where that transition makes sense. Also, 2 years ago, we introduced a rotational internship as a way to respond to the challenge of the alternative sector not demonstrating sufficient levels of diversity, and thinking about a way from a practical learning opportunity that we might be able to bring new talent into the sectors of private equity first, but also real estate and other alternative asset classes. The program is now in its 3rd year, and we focused first on private equity. The program, as it is designed, is a rotational program for 12 months, giving the individual an opportunity to work with the firm, to then work with an operating company, and then wrapping up the 3 months of their 12-month rotation with a pension fund. And it really was to, again, provide a 360 view on the investment cycle and, again, enhance the education. And should that individual coming out of the program move into a private equity firm, it also would make them a better client-facing professional with the knowledge of really what is expected on this side of the business. We would invite CalSTRS to, certainly participate in that. We have had the state of Connecticut, the state of Florida, Texas Teachers is participating this year, and we've also had CalPERS. So again, we would welcome at any time outside of this meeting the opportunity to talk about this if it were deemed to be appropriate for CalSTRS. As well, we host educational events where our pension representatives are panelists and speakers. We have one coming up in August, and Chris, along with the CIOs from Lacera and Lacers, and possibly City and County of San Francisco, will also participate. It's a great way to convene both our alumni and our students, along with investment professionals, to talk about topics. And it's something that we do around the country as a way, again, to keep Toego sort of at the hub of sort of what is transpiring that's important and how does it translate to the educational and professional development of our group. I talked a little bit about board development, but I did want to acknowledge the wonderful collaboration that we've had with Ann Sheehan, other members of CalSTRS, along with CalPERS, to really enhance our pipeline initiative. Our program is called All Aboard, and it was designed both as an online platform and as well forums where we can provide greater education about how to position yourself for the future. Currently, we also have about 500 registrants in our database, but many of them are sort of at the mid-career level, but a great way because we took the time to look at some of the architecture of the 3D platform to make sure that the criteria and the questions that were put forth actually allow you to look at that group from sort of the same lens. And we're hopeful to see individuals over time transition, and we also equally market the 3D product as well. You know, in terms of what we could do further, I mean, I really think that, you know, given that we share one important mission together, and that is education, the extent to which the Toego Foundation may be, you know, a facility for you in terms of outreach and education to underclassmen is a great way that we might be able to work together. We're out in the marketplace often talking about and trying to inform about opportunities with careers in finance. Toego's been asked to take our model down to either the undergraduate level or the high school level. But again, thinking about the best ways to do that requires, one, both the financial resources, but also someone who has the knowledge of that particular space to understand how to navigate through that. But we are definitely talking about that from a strategic standpoint, and would welcome if there's any opportunity for us to be of service to the interest of the board members and your constituents. Lastly, next year is our 25th anniversary. And we are purposely going to be celebrating this event around the country. So there will be several events and opportunities for both information exchange and our celebration. And we would certainly welcome if any members of the board or staff were able to attend, and announcements regarding those activities will come out later this year. With that, I will open it if there are any questions at all. Other than that, thank you very much.
Thanks so much, Nancy.
Thank you.
Thank you. Thanks. Oh, go ahead, Michael. Can I get you in there?
Thank you for coming out. As a person who is on the legal side, been involved in matters dealing with diversity, I applaud the way in which you have approached this. I think this is fantastic. I'm embarrassed to say that I didn't know about the Toego Foundation, but then I don't have an MBA, so maybe I shouldn't. But I am very impressed with what you have done and what you are doing, and a very impressive board of directors. I'm very pleased to see CalSTRS participation and would encourage us to do more. This is very exciting. Our firm, around 25 years or so ago, maybe 30 years at this point, no, it's about 25, set up something very on a different level called the Skadden Fellows Program, where we identified law students who wanted to go into public service, and we provided monies to help them pay their legal fees and to pay for their first 1 or 2 years worth of salary for tax exempts that they wanted to work for. So it benefited the tax exempts and it benefited the students. And it's a model that's similar to what you've devised. And the one thing that came out of it was that the prestige of being a Skadden Fellow followed them throughout. And so it sounds to me like you're doing something very similar. And I think it is fantastic, and I want us to encourage it as much as possible.
Thank you. We'd love to continue to work with you.
Tom?
Not a question, just a comment. I've been familiar with the work of your group for maybe 10, 15 years. I really congratulate you for all that you've done, and just want you to know that as a new board member here, I'll do what I can to be supportive of your group as well.
Thank you very much.
Nancy, I didn't know about Twigo much. I'd heard Chris mention the name before, but so I really appreciate having more time to hear about it because it's something that I've just, heard glimpses of. So I really appreciate the work that you're doing, and I agree with the fellow board members that I think the interests are very similar, and so it'd be great to continue to work and support your mission. And so thanks for coming to tell us.
Thank you.
Okay.
I'm gonna send you a couple of applicants too.
Please.
Oh, I got one more from John.
Actually, I'd like to make a comment, or actually pose a query. Can you give me a little bit more information about the thinking about extending the program to high school students? Obviously, it's a significant challenge in terms of financial literacy, and so I don't know your most up-to-date thinking on this topic.
Yeah, I think as far, John, as we have gone on this is to put it on the table for our strategic planning. But as I mentioned, one of the key issues is really having someone on our team who has greater familiarity with the space so that we can, again, do as we've done with these other programs, figure out exactly what a model might look like. But, one of the things we've talked about is really to narrow it to a California initiative. Twigo evolved, as you well know, over time to become national, and that was critical for, I think, the reasons that Bob and Sue put it in place. This, on the other hand, I think because of the age group, you also need a much higher touch and an opportunity for follow-up. And so I think that we want to be able to either look at this regionally or on a statewide basis. So if there's anyone here who has ideas about that, I would welcome that. And it will continue to be a discussion topic, for us for the remainder of the year. Yeah, I saw that.
You go first.
Yeah, for the remainder of the year.
Have more extensive conversation about this. I had a legislative proposal that was picked up by a legislator, signed into law, so we have it in place. But you don't see anything systemic. You don't see best practices. So obviously, we're actively reaching out and soliciting feedback in this area, and so your participation, to the extent that you're comfortable, is highly welcome.
Oh, wonderful. I'd love to do that.
One more, Rich?
I was just going to add, let us know. We'll be happy to help you out on this. The controller is right. These are extremely difficult to organize and get going, but we've been concerned about financial literacy for a long time. We'd like to work with you on that at the school level.
Thank you.
Nancy, what I'd like to add, well, obviously we have a lot on our plate already, but there's some seeds being planted. We got the chance, we're working with NASP, the National Association of Securities Professionals. Well, I've had some fun creating some in-state rivalry. Obviously, that's not hard between NorCal and SoCal. But the Southern California chapter in LA has done a wonderful job of connecting with a great teacher at Crenshaw High School. And they mentored about, I'm going to say 9 kids to encourage them to go on to college. They were all pursuing very different career paths, but Crenshaw does not have a big college enrollment out of its high school, but they got a chance to go to downtown LA, work in business offices, and realize there were career opportunities. So I did a speech for the San Francisco chapter and challenged them to double that number. And I think we would be a wonderful position to try and help connect with CTA, connect teachers that have a passion to teach that side of business and connect that. We know the securities professionals, and then maybe if we can leverage off our connection into the classrooms, I think we can really get something going across the state, especially in the inner city schools that encourage college. And then, as we've said to Nancy, part of the challenge is getting these kids into business school. They see mentors or they see examples in TV of medicine and law, but they don't see Wall Street as a evil, nasty place, and they don't see examples of where there's a whole career path for them. So that would be a lot of fun. And it'd be fun to work with NASP and get those chapters fired up.
Great.
Dana?
No, Chris,
I'm not letting you go, Nancy.
I see Maggie shaking her head back there, so I think between the two of you getting your heads together. But that brings up, I mean, how often do we have any of the business teachers here around the Sacramento region actually bring kids in for field trips to look at the trading floor or do anything like that? I mean, maybe that's something that we can also do to,
Yeah, and
on
sadly,
a
the
whole
only
nother
time we ever
track.
did it, Peter Renke brought a class of kids from Oakland, and they got to sit up here, and that was great.
okay, we can, I think we can work on that too, those of us that are teachers and know teachers around the area. I think that would be cool
We've got to
too.
get them young.
Thank you.
Great. I think we're good. Thanks so much, Nancy. I'm going to ask the board, we're going to look at 3A and 3B. These two items are consent items, and then I'm going to ask your discretion to move to opportunities for statements of the public. I see our colleagues from Unite here sit here, so if you guys can look at 3A and 3B, it's a consent item. So does, they're consent items, I should say. So does anyone want to pull either of these items from consent? So I'd entertain a motion to approve 3A and 3B.
So moved.
Second?
All in favor? All opposed? Great. All right. So again,
Can I just ask
Sure.
a question? I mean,
sure, absolutely. Just go ahead and key in there.
I know that there are a few board members who are under time constraints today.
okay.
So I want to make sure that we're going to have enough time to deal with the item that was going to come next. And I just want to get consensus,
Okay.
an agreement that we are, because I think
That's
that's
fair.
the most important issue before us
Absolutely.
every 3 years, and I want to make sure that we're able to do that, so.
That's a fair. So we have, it's 11:30 now, and I know board members need to leave around 2 is what I understood, correct? So, and I assume that there'll be lunch somewhere in there, or people might be.
So we may not
So
have
we,
time.
so,
I just want people to recognize that we just may not have time. So,
well, I guess the other option is to wait for Unite here until we finish the number 4. Is that amenable to my colleagues? Okay. I concur. I appreciate your comment because I
mean,
know.
I don't want,
No, I
I
appreciate
understand
that.
we have people who are.
Is,
who are-
how
who
does the rest of the
comment.
board feel? As some of you may or may not know, several of our board members need to leave at 2:00 today. And again, many of you know that item 4 is our key allocation decision factors. And hopefully, my goal as your chair is to get us to make a decision today on this item. We've spent a lot of time dialoguing. We're going to be voting. It's a critically important decision to make for our investment committee. So I would concur. So I'd like to kind of hear the other board So the question is, should we just go ahead with item 4, step into our allocation, and then we'll hear from our colleagues Unite here after that item? Is that okay?
Go ahead.
Okay, let's do it. Okay, great. So thank you, colleagues. We will look forward to hearing your comments, and I appreciate your flexibility.
You might want to let him, this is gonna be a while.
Yeah.
Well over an
And
hour.
just, Alyssa and Unite Here colleagues, I just want to let you know, I have no idea how long this is going to take. So just FYI, it might
So we
be,
break for
so
lunch
we'll
afterwards,
break
too.
for a little lunch. And so I'll just kind of keep, if you can just check in with me, I'll keep you posted. Okay? Thank you. Thanks for your flexibility. All right. So we have the PCA guys. Alan, Neil, Bob, welcome.
I am going to kick it over to Neil and to Bob and let them get right in it. And Neil is not going to go through every slide. I don't want to bring that up again. And we'll jump into it. Go for it.
Okay, for the new board members, to my right is Alan Emkin, founder of PCA. He's been serving CalSTRS for somewhere around 3 decades. My name is Neil Rue. I'm managing director at PCA, and I've been working with Alan for over 20 years. And to my left is Bob McCory. He's our actuarial expert. He, at Chiron, in conjunction with PCA, have put together a best practices asset liability model that's been in place, and we've been working together for over 10 years. PCA found out about this patented model when Bob was implementing it back at CalPERS somewhere around 10 or 15 years ago. So just a little bit of quick history there for the new board members.
As Vice Chairman Hendricks mentioned, we've been dialoguing about asset allocation for a long time. We believe we're at the ultimate presentation, if not the penultimate presentation, with the ultimate presentation just being execution of a decision that we hopefully will make today. And so the presentation for the new board members, the presentations up to this point, there's been a lot of dialogue about the model that we're going to use, about all the assumptions that go into the model, about what the model says and produces in terms of data and analytics. You're going to see a lot of that. That has been revised based on information coming from the board members already. So we're going to assume that you have reviewed the materials that are in the presentation, and we're going to pretty quickly get into getting used to using the model, and really just sort of diving into that. If I could have you turn to slide 8, I guess I can go there on your behalf. This is a summary of the model. You'll be seeing a lot of this today. And you'll recall for the last couple of presentations, we've talked about, and the key issue that's sort of left on the table is what is the board's collective view about risk tolerance or the riskiness that you're willing for the system to take as expressed through the asset allocation decision on the asset side of your balance sheet. And so we need to get that information from you. We as your consultants cannot tell you that. And the patented model that Bob put together, which is reasonably elegant once you understand what's going on, is to extract that information from you folks so that an asset allocation policy can be established pretty quickly. So we have this slide here, and you're going to see this in the model. We dialogued a lot about the risk issues, and it really boiled down to 4 risk issues, and those are in those colored boxes at the top. And they're fairly quantitative at this point, because what we do is we rank every single possible portfolio on their ability to meet these particular risk thresholds. And we talked about these, and you approved them. So I'm not going to read them. I'm just going to highlight that there are green boxes there, and there are red boxes there, and they're colored that way for a reason. And the green boxes, if you were to put emphasis on those green boxes, you're really finding a portfolio that's more aggressive in nature, more return-seeking in nature. If you put emphasis or weighting on the red boxes, you're really thinking more in terms of principal protection, asset protection, short-term protection of the system. That's the allocation that gets produced. An allocation that's geared more towards that than otherwise. Now, the allocation that will result from this moves within a set of bands, constraints. It doesn't go from 0 to 100% equities, or there are these constraints that the board already approved that are in the appendix of the presentation if you want to look at them. So there is some bounds around in which the allocation moves. But how you emphasize these, and we're going to get into using the model, how you emphasize these 4 risk considerations will influence, not all the time, the model's not perfect and sometimes it's sticky, but it will influence the policy allocation in that direction. Does that make sense? Okay. Let's see here. So just as a point of reference, I'm just going to hit a couple of things, and then we're going to dive into using the model. So when you did this last time, you had a set of risk factors. They were different risk factors, and you can see here by the slices of the pie there were 5 of them, not 4, but they had the same kind of green, red kind of flavor to them. And I just wanted to highlight that in 2009, when the board went through this similar process, the tilt was 60% towards return-seeking type of factors and 40% towards more protection-oriented factors. I'm not advocating a position at all. I'm just saying what you did last time. That resulted in the policy that you're now implementing. So it's just a point of reference for you.
Oh, sorry. Hang on 1 second, Neil.
Yes.
The names are all messed up on this, so you'll have
Yep.
to. Okay.
It's
got
me.
it. Go ahead. Mike.
So on here, I see that last time there was a sort of a factor for the cost of the investments, which is missing sort of in what we're looking at today. Can you talk about how that plays into the 4 scenarios that we're working on in terms of the average planned cost?
Sure, I can give the investment consultant two-sentence version of that, and Bob, you might want to chime in on that. The interesting issue with respect to costs, with respect to CalSTRS, is you really have to accept costs. You cannot influence costs through your process. And we have actually created two models. We're only going to be looking really at one. One is assuming that the state contributions pattern remains intact going forward. That's the one we're going to be looking at and emphasizing today. We do have another model in our back pocket, if you wanted to look at that, that reflects SCR 105, scenario 1 in SCR 105, which is the most optimistic state contribution support scenario that was presented in that report. And if some, you're out, the contribution is somewhere between those two, and we took the extremes on both ends. To the extent that there was something in the middle, this is a model and a tool. You could come up with almost a straight line between the two scenarios to come up with some kind of policy that would reflect some kind of middle ground. I mean, do you have anything more to add to that?
That's fair.
Yeah.
But it's, as opposed to the sister fund across the river, where they have the ability to impact costs, this board doesn't have that ability. That's vested in the legislature. And therefore, we don't really have the ability to second guess the legislature. We know what the facts are today, and these decisions and recommendations are based upon what is known. At the request of a board member who wanted to know what if funding changed, a lot of analysis was done, but it's only academic in nature because it has no real impact upon policy. And before we get going, a key bullet point. No matter what you do in asset allocation, it'll only impact the financial condition of the plan at the margin. Investment cannot solve the financial challenges that this system faced. It can improve things, or in fact make things worse, but it won't, in quote, solve the problem. And it's just very important to recognize that at the outset.
Yeah, and that, Alan makes a very good point. Those are summarized on slide 12 here. That goes straight to Alan's point. There's been a lot of discussion about potential solvency, either long-term or short-term. If you assume that the state maintains the status quo contribution level, asset allocation really is not going to be able to impact that at all. And we'll show you some graphics on that in the format that was requested. Couple just other basic findings that we, in testing the model out before you see it, if you try to seek against a near-term crisis, it's like a water balloon. You're going to protect it over here, you're not going to get it over there. So if you try to seek protection against a near-term crisis, it's going to hurt you in the long run. That came out, and you'll see that. Another thing that pops out is that the current allocation policy against what we might think might be something analogous to a reasonable weighting that the board might, or the investment committee might come up with. The current allocation policy is reasonably competitive against that, and maybe you'll see that today. And we'll just begin to, we have a lot of data here on these following pages, but instead of going through these slides, we're going to use, Bob's going to dive in and start using the model, and we'll walk through some of these scenarios so you can see how the model works. So, John, if you can bring up, or the IT folks can bring up the spreadsheet, we'll start diving in there.
Can I ask a question before we get into using the model? As you know, these four descriptions have always sort of confused me, and I thought it was very, very helpful that you gave us so much data on each one of them. Version 2 and scenario 2 and scenario 3, one of which is green and one of which is red, have almost identical results. I mean, virtually identical results. The asset allocations are off by 1 percentage point.
2 and 3. 2 and 3.
2 and 3, right? Yes. 2 and 3.
Agreed.
And the the outcomes in terms of, 5 years, 10 years, et cetera, and the standard deviations are almost identical. So I'm trying to understand if I say I'm conservative and I pick 2, and somebody else says they're aggressive and they pick 3, they're picking exactly the same portfolio. So why is it that we're not really having choices here? Why is it that when we say we want to be aggressive on the one hand and we want to be conservative on the other hand, that we come up with the exact same portfolios, unless you guys have solved the risk-return trade-off, which is wonderful if you have. But I don't really think, what I'm saying is, as I look at this, I don't see that we have choices. Because we define choices, but then we didn't actually produce choices.
Well, I think you do have choice. In particular, 3 to 4, the seeking a high return and seeking a low probability of a 2-year drawdown are symmetrical, and they will get you anywhere on the efficient frontier you care to go. The point here is that minimizing the likelihood of pay-go status with statutory funding just doesn't work in a certain sense. Alan got to this point, which is if you're stuck with statutory funding, your likelihood of going to pay-go is more or less fixed and pretty independent of how you invest. Now, what'll happen is, and we can see this as soon as the model comes up, if you put 100% of your weight on the pay-go status, as you noted, what happens is that the model says, hey, look, it's bad anyway, just shoot for the moon. Because your only hope of avoiding pay-go status is spectacular investment results. So in the context of statutory funding, then avoiding pay-go is not a conservative alternative. Interestingly enough, if you have actuarial funding, then the pay-go has much more of a conservative bent to it, and it will give you more conservative portfolios than it will be here. But to some degree, statutory funding and avoiding pay-go status is kind of like oil and water. Just
Well, that's a very helpful explanation. One other question, though, that I have is, we go through this process every 3 years. And again, raising an issue that I've raised before, I find it confusing that each of these scenarios has a different time horizon. Some are what we accomplish over 20 years, some are what we accomplish over 10 years. And it seems to me that really what we all, and so for example, you can take 4 and you can say, well, 30 years from now, the outcome of option 4 is a lot worse than the outcome of any of these other options. But we're not choosing an investment strategy for 30 years. We're choosing an investment strategy for 3 years. So shouldn't we be really looking at what the outcome of any of these 4 options is over 3 years? Because I don't expect that we're going to stick with any of these. I mean, if I wanted to choose the one conservative option here, I wouldn't be choosing that we stick with it for 30 years.
as a policy, well, 2 things. Number 1, your decision factors are naturally going to have different horizons, because your concern is both with comparatively short-term and comparatively long-term. I mean, when you drive down the highway, you're certainly concerned with the general direction that you're going, but you have to watch out for the boy running across the street after the ball, that kind of thing. So you've got to maintain kind of a mix, and that's what these decision factors are after conversations with the board here, is a mix of near-term concerns and far-term concerns. Now, if you're talking about kind of just going from one 3-year period to the next, you're really talking about tactics. What we're trying to talk about here is more long-term strategy. You know, what is the long-term strategic balance of risk and reward that this board wants to set. And that's what we're about here, is trying to set that. And then you will vary it from year to year as the investment markets and your staff tell you is an appropriate tactical move.
But we're doing this in the context of reviewing our expected returns. So this is driven tremendously by, for example, I would assume, the fact that our expected returns in fixed income have been reduced significantly, that we would have a different outcome if we had that. So if we're basing this on shorter term expectations of investment returns, how can we make longer term investment decisions? It still seems to me that what we have here is we have a choice about asset allocation for a relatively short period of time based on what we think are our near-term expectations of investment returns by asset class. Again, I think we're mixing apples and oranges to choose a long-term investment strategy based on short-term investment expectations, and I can't get comfortable that makes sense to me.
There's a line from the movie Hero, uncomfortable. Uncomfortable is what you should be. And what I mean by that is that actually our job in this endeavor is to make you ask and answer uncomfortable questions and make uncomfortable decisions.